Thank you, everyone. Thank you for joining in. Nishant Katyan, this side from FIEO, your host for today. I'm joined by my colleague, Mr. Arpan, and Ms. Sunita is also online with us. Friends, we also have with us Mr. Isaac Tudu, who is one of the most prominent and known speakers, and one of the very known faces in the exporting industry, in the export fraternity. We welcome you, Mr. Isaac, once again with us. Thank you for sparing your time.
Thanks a lot.
Just to give just before I hand over the portfolio, the platform to you, sir, I'll just take a small span from you, with your permission, to give a brief introduction of yours to the participants of today. Mr. Isaac Tudu is an owner of Tudu Financial Services, a consultancy firm engaged in providing trade finance services to SMEs and bankers from 2019. He is an ex-banker with State Bank of India and ICICI Bank, having experience of over 25 years. He was engaged with the State Bank of India from 1995 to 2010. His last assignment was as the head of largest SME branch, that is specialized commercial branch in Surat, catering to the credit and trade finance needs of SMEs and the corporates. He was then engaged with ICICI Bank from 2010 to 2019, wherein he was assigned as the regional head of sales in the north and the western Gujarat, based in Ahmedabad, responsible for catering to the commercial banking and trade finance needs of SMEs and the corporates. Friends, on the same lines, FIEO has proposed today's session, which talks about export credit and finance for the exporters. The objective of organizing the session on export credit was to educate the industry about available financial assistance, enhance their understanding and the application of the processes, and address common challenges they face in accessing export financing. Ultimately, the idea is to empower you to effectively expand your wings and arms into the international market, into the international trading arena. The agenda will cover 4 aspects. To cut short, it is when, how, whom, and where. Now, to elaborate on all these when, how, whom, and where, Mr. Isaac Tudu is with us. He'll be teaching us the entire mythology and the ideology of this export finance and export credit. Well, just to brief the new people, the entrepreneurs who have joined us today, export credit also refers to the loans or the credits which are extended by the government or any financial institution to support the export of goods and services into the international market. The financial instrument is primarily aimed at enabling exporters to conduct international trade more efficiently and securely. So this will be more in deep taken care and tailored by Mr. Isaac. Sir, over to you. Thank you so much. And I wish you all the participants and wishing you all the best. Thank you, sir. Over to you.
Thanks a lot for a warm introduction, or you can say very lengthy introduction. So I welcome all the participants on this webinar on export credit for exporters. So without taking much time, I will simply go and start my presentation. So I'm going to share my screen with all of you. Please let me know that my screen is visible or not. So I believe my screen is visible to all.
Yes, sir.
Yes.
Okay. So let us start our this particular session, which is topics is basically export credit for exporters. So we all know that India has already aimed to achieve, you can say, $2 trillion by 2030 goods and services exports. This is our goal. India's goal is to achieve $2 trillion goods and services export by 2030. And what is the current position here? 2023-24, we had achieved roughly around $770 billion overall exports. So you can say that there is a gap. There is a literally huge gap, and we need to promote export to contain that gap or deficit. We all know that Ministry of Commerce through DGFT regulates foreign trade policy and takes other initiative to boost India's exports. As well as RBI is there. RBI also comes up with various guidelines to boosting exports. we need to understand that export credit is basically have been included in priority sector. So banks, when they lend to the exporter, they give export credit, means they will be doing or lending to the priority sector, right? With this background, we will understand what type of export credit we can avail from the bank as an exporter, right? So here we go. What is export credit? We can simply say that export credit, you can say that pre-shipment, post-shipment, these are the two components. So today, whatever we are going to cover, I'm going to tell you right now here. So we are going to cover pre-shipment. Within that, we will cover EPC in rupees, PCFC in foreign currency, who can avail packing credits, what would be amount and period for packing credit, what is the procedure for disbursement of packing credit, what happens to pre-shipment credit when exports do not materialize, how to liquidate EPC, how to repay PCFC when EBR or export realization does not happen. Then we will cover post-shipment credit. There we will understand what is foreign bill discounting and export bill rediscounting EBR. Then we will cover how do banks assess export credit. And we will also cover there how to approach bank for export credit. Then we will cover RBI's gold card scheme for exporter. Then we will cover bill discounting under LC. Then we will cover factoring, and one more topics I have decided to include ITFS, International Trade Financial Services. So with this, let us start our session related to export credit, right? So export credit, you can say in very simple terms, I have shown here, can be divided in two categories. One is the pre-shipment, another is the post-shipment. Simple. When we say pre-shipment means loan given by a bank to an exporter for funding the purchase, processing, manufacturing, or packing of products prior to shipment. So within that pre-shipment credit, this can be availed in rupees. We will call it EPC, pre-shipment credit or packing credit in rupee. And pre-shipment credit also can be availed in foreign currency, that we call it PCFC, pre-shipment export credit in foreign currency. So once goods are shipped from India, then there will be no stock and there will be receivables. For there also, there comes the bank finance post-shipment credit. So you can say post-shipment credit is extended by the bank after the shipment of goods till the date of realization of export proceeds. So within that segment, post-shipment credit, you can say post-shipment rupee export credit, foreign bill discounting, and post-shipment export credit in foreign currency, export bill rediscounting, EBR. So with this background, we will understand each and every segment in detail, especially the first part, how to avail EPC, or you can say pre-shipment credit. We will more focus on that. So here we go. Pre-shipment credit. What is this? Already I have told. It is loan given by a bank to an exporter for funding the purchase of the raw material, you can say, processing the raw material, manufacturing the finished goods, or packaging of products prior to shipment will be called as pre-shipment credit. Okay, so it can be granted in rupees. We call it EPC, export packing credit, or it can be availed in foreign currency, packing credit in foreign currency, PCFC. Fine. So depend. You are an exporter. What do you want? You want to avail pre-shipment in rupees in the form of EPC, or you want to avail pre-shipment in foreign currency in the form of PCFC. Fine. So pre-shipment credit is usually granted to the eligible exporter against lodging of confirm order or LC. LC means export LC in our case for exports of goods. It has got two essential features. The first thing is existence of an export order, confirmed export order, or maybe LC, and liquidation of the pre-shipment credit by submission of export document within a stipulated period. Let us understand further on this. Who are the eligible exporters to avail EPC facility? Okay. Manufacturer exporters. Who are they? Exporters that produce the goods themselves and export them under their own names are known as manufacturer exporters. So if you have got the order from abroad, you are going to manufacture the goods and then you ship the goods, means you are manufacturer exporters. Merchant exporters, also known as an intermediary or trader, does not produce the goods themselves, but rather purchase them from a domestic or international supplier who is the original manufacturer, and then they export under their own name. Merchant exporters. You can say they are the trader. In these circumstances, the shipper is also known as export holder, order holder, EOH. Then export house also can avail pre-shipment credit, means manufacturer exporters or merchant exporter with minimum export turnover as prescribed under the prevailing foreign trade policy. And suppliers and sub-suppliers also can avail this pre-shipment credit. Who are these guys? Suppliers or sub-suppliers? Maybe they are supplying the goods to a person who in turn uses their goods for export, right? So here comes the deemed export, right? So they are also eligible for pre-shipment. We will go further and understand few more concepts. What is the quantum and what is the period for pre-shipment credit? How much you can avail? Is there any fixed quantum is there? Or what is the time period you can avail for EPC? So there is no fixed formula for determining the quantum of finance to be granted to an exporter against a specific confirm order or LC. Then how bank assess? It will be basically need-based finance. Okay. The guiding principle to be applied in all such cases is the concept of need-based finance. So bank will assess the working capital requirement of the company, whoever has approached for pre-shipment. Okay. So what is the operating cycle? Based on that, they will arrive what is the quantum of finance you require as an exporter. What is the period? The period for which the bank gives pre-shipment finance depends upon the manufacturing trade cycle or specific requirements of the individual export. Normally, not exceeding 180 days, extendable by another 90 days up to 270 days. But most of the bank will restrict only up to 180 days. Maybe it is lower than that, right? Maybe 90 days also. Okay, depend on your working capital cycle. What is the percentage of margin bank would require you to keep? The percentage of margin is determined depending on the nature of goods, commodity, capacity of the exporter CTC, keeping in view the spirit behind RBI guidelines for liberal finance to export sector. So depend bank to bank, what is their internal policy, and they will assess the proposal and they will fix the margin. EPC loan are usually restricted to the lower of 90% of FOB value of the contract or the domestic cost of production. So this is brief about the quantum and period up to what time you can use EPC facility. So for example, you have been sanctioned only up to 90 days. That means what? Today, EPC has been disbursed to you based on the export order. So you have got export order for $10,000. That is the FOB value of the export order. What bank will do if they have already sanctioned the limit, then they will disburse 90% of the FOB value, and that amount will be parked in your account, right? So 90 days is the time given to you. Within that, you need to ship the goods and present the documents to the bank. Maybe it is up to 90 days, then obviously that time is available to you, 180 days. Within that, you need to submit the documents to the bank for that particular confirm order. Okay. Going forward, few more things we need to understand. What is the process for disbursement of EPC? Quickly, we can see here, export order or LC. LC means export LC should be deposited with the bank prior to the disbursal of the pre-shipment advance, except when the advance is sanctioned on running account basis. So there are two concepts, how you can avail EPC. Okay. So it could be order to order basis, means if you are not enjoying running account basis, means you have to submit order, confirm order, and bank will disperse the EPC based on the order. So each and every time, whenever you want to avail EPC, you need to submit export order to the bank, and bank will simply see how much is the value, FOB value, and what they will do, they simply take 90% of that, and they will disburse the amount to you. So for availing EPC, for order to order basis, always you need to submit order, confirm order to the bank to avail the EPC. But that is not there in running account basis. We will learn that. So up to 90% of FOB value will be given to you. EPC is allowed up to 90% of FOB value of the export order. If the advance is given on order to order basis, the amount advance will be recorded in the relative order or LC, as the case may be. Bank will simply keep a record that against this order, 90% EPC has been already disbursed. So they will keep track on that. If you have been given 90 days time period, then within 90 days, you need to submit export documents to the bank for that particular order, right? The packing credit may be released in lump sum or in tranches as per the requirement for executing the confirm order LC along with ensuring end use. So depend what is your requirement. Most of the time it will be released in lump sum, so entire amount will be disbursed. But it is possible in few cases you will not have the requirement, but you will have the requirement in tranches. Then bank will accordingly release that 90% of FOB value in tranches, phase wise. That is also possible. But yes, practically most of the time, entire amount, 90% of FOB will be disbursed at the beginning itself, right? So next is basically, we will understand few more concepts related to this is running account basis. So it will be very challenging for any exporter if he has to always submit export order to avail EPC facility from the bank. Okay. So there comes one facility that is running account basis. So here in this case, exporter is not supposed to submit export order to avail EPC facility, right? But who can avail running account basis facility as far as EPC is concerned? So banks may extend the running account facility only to those exporters whose track record has been satisfactory. That is one part. As also to EOU, export oriented unit, or units in free trade zones or export processing zones, and SEZ, special economic zones. So those clients can be given running account facility to avail EPC, right? So running account means you are not supposed to submit each and every export order whenever you want to get the EPC loan to be disbursed, right? But what is the meaning of track record? Or you can say whose track record has been satisfactory. So exporter whose overdues do not exceed 5% of the average annual export realization during the preceding 3 financial years may be considered as exporters with good track record. Okay. So if you fall into this category, maybe bank will be willing to extend you the running account facility to avail EPC facility, and that will ease a lot of pain, right? So in this case, what will happen? Confirm order or LC should be produced within a reasonable period of time to be decided by the bank. And most of the bank will stipulate that, okay, you avail EPC facility based on the simple request letter. You can simply request that today you disburse $10,000 or $20,000 within the overall limit, obviously. And at the end of the month, maybe first week of every month, you need to submit all the details of the you export order or LCs. So there is no need to submit every time confirm order or LC to the bank to avail EPC. You need to simply request the bank with a letter that you want to avail. And as per the bank's sanction letter, you need to submit only monthly basis all the export orders or LCs. Okay. Maybe bank has fixed on 5th, you need to submit all your orders or LCs. So you need to submit that one time every month, right? And obviously all the confirm orders or LC should cover whatever EPC you have already availed, right? So in this case, substitution of contract or export orders is also permitted in case of running accounts. Okay, so maybe you had got one order for $10,000 from country A. You have already availed the EPC against that. But what if that order is cancelled and you have already availed EPC against that order? So you can replace that order with the another order received from country B or buyer B, right? That is quite possible in case of running account basis EPC facility. Banks will mark off individual export bills as and when they are received for negotiation or collection against the earliest outstanding pre-shipment credit on first in, first out FIFO basis, ensuring that export credit available in respect of individual pre-shipment credit does not go beyond the period of sanction. So since here, what will happen that based on your request, bank has already disbursed, bank has not been able to track whether that 60 days, 90 days, whatever time period bank has given to you, within that liquidation for that export EPC have been done or not. So whatever inward will come, that will knocked off, that will go towards liquidation of EPC. So first in, first out basis. Okay. So that way, that period, whatever 90 days or 180 days you have been given by the bank, it will not overshoot. Okay. So this is running account basis facility available to the all the exporters. If you have got the good track record, okay, so you can apply your bank it will ease lot of burden. Okay. So now coming to the next, what are the important points we need to understand related to EPC pre-shipment credit? So exporter should not be in ECICI's special approval list or CIBIL or RBI's list of defaulter or caution list. Destination country for export. Many of the time, few of the countries are there who are in caution list with the bank, right? So maybe your bank may not would like to handle export transaction which is related to that particular country, and you have submitted the export order belonging to those countries. So that things need to be taken care at the beginning itself. Bank, you need to tell the bank that these are the countries where you will be doing the export, so that they can take a call, they can guide you whether they'll be able to extend EPC facility against those countries export or not, right? Obviously, this we have already discussed. 180 days is the maximum time. Usually bank would not extend that, but it can be extended up to 270 days. IC number, obviously, import export code would need to be there. Registration with export promotion councils. And we need to understand lack of collateral should not be the reason for denial of any proposal. Okay, so you have requested the bank. Usually what will happen that bank would try to explore collaterals while they want to give the pre-shipment credit or post-shipment credit to you. Lack of collateral in this case should not be the reason for denial of the proposal by the bank. This is we need to understand. ICICI bank may insist for obtaining ICICI policy, but waiver could be there. Okay, depend on the bank's internal policy. Most of the nationalized bank would require that exporter need to take ICICI policy. Maybe private banks, they may waive this requirement. Okay, but it is strongly recommended that exporter should mitigate the risk by taking the ICICI policy, right? So how this entire transaction of pre-shipment is monitored by the bank? We need to remember this, that monitoring is an important part for the bank. Why? Because since packing credit loans are at concessional rate of interest and specific purpose oriented advance, it is the responsibility of the bank to ensure proper end use of the amount they have disbursed to the exporter, right? So to ensure the end user funds, loan amount usually would be disbursed directly by the bank in the name of the supplier. But maybe that is not practically possible. Means you have approached the bank with the export order for $10,000. Maybe bank is willing to disburse 90% of that $9,000 in rupee. They will convert it to rupee. So bank is expected to disburse that amount directly to the supplier of the raw material for you. But that will not be practical. Then what will happen that usually bank will simply debit the EPC account and credit your current account or cash credit account maintained with the bank. So where direct disbursals are not possible, the proceeds may be credited to borrower's account and disbursal there from there will be supervised by the bank. What is the end use of the fund? Remember again that EPC is given by the bank at a concessional rate for the exporter. It will be lower than the rate which is applied in cash credit, or you can say overdraft facility, right? So pre-shipment credit is required to be liquidated from the proceeds of the relative export bill when bills are purchased, negotiated, or discounted as the case may be. So usually when bank sanction pre-shipment, bank would also sanction within that or maybe separate limit by way of post-shipment also. So what they will do, when you will submit the bill to liquidate the pre-shipment, they will simply purchase that export bill. They will liquidate the related pre-shipment outstanding and they will create post-shipment outstanding. So basically, till the time shipment is done, it will remain in pre-shipment. And once shipment is done, it will become, your outstanding would become post-shipment. So let us take an example that first time you have availed EPC facility. So you have submitted $10,000 export order to the bank. Bank has already disbursed 9,000. What they have done? They have debited your EPC account and credited your maybe OD or CC account. So there is an outstanding of rupees equivalent of $9,000 in EPC account. So maybe 90 days have been given to you. Within that, you have manufactured the goods, you have shipped the goods. Now there is no goods available in India. Why? Because goods have already been shipped. There is no stock. Then now it has been converted into receivables, export receivables. So what you do, you submit the export bill to the bank. So bank will convert that export bill, means they will purchase, they will create post-shipment liability, and they will knock off the pre-shipment 9,000, whatever amount was given to you, right? So that is the way they will knock off the pre-shipment by purchase, negotiation, or discounting of export bill. Export order can be substituted with another export order even if the commodities covered differ, subject to the condition that there is no change in the terms and condition as applicable for pre-shipment and post-shipment credit with reference to period, rate of interest, etc. So this is something we need to understand, that you had received one order against which you have already availed EPC facility. Now you have started with the amount, you have already procured the raw material, you have already started manufacturing the goods. In the meantime, for any reason, that order is cancelled. But you have got another order from another buyer abroad. So in this case, that substitution is possible. Only thing we need to remember that terms and condition of the pre-shipment and post-shipment finance need to be the same. Like if it was 90 days, then 90 days, whatever rate of interest and other things need to be remain the same. That is, a substitution of export order is possible. This facility of substitution of order or commodity is allowed only in the running account facility and when it is considered that substitution is commercially necessary and unavoidable. Not the order to order basis, right? So order to order means today one order you have given to the bank. Okay, this is the export order. They have already disbursed. Then it is expected from the exporter that the exporter will ship the goods and presents the documents against that order. But in case of running account, multiple orders will be there and one order can be replaced with another order. So that is quite possible. Okay, so bank usually will monitor EPC, pre-shipment credit. Why? Because it has been given on a concessional rate to the exporter. And remember one thing, not only the concessional rate is given by the bank, but exporter can avail interest equalization. Means government usually provide this facility to the exporter that there will be some cost of the interest, maybe 2%, 3%, depend on your products. So I believe that interest equalization scheme was valid up to only 30th September, but maybe it will be extended, depend how it works. So we need to wait for government's decision. So that will be applicable only when you have availed export credit facility. So if you have not given any interest to the bank, very difficult to avail interest equalization from the bank, from the government, right? So for example, you have been charged by the bank 8% and there is an interest equalization scheme is there for 3%. So effectively, bank will charge you only 5%. because 3% is the interest equalization scheme which will be given by the government, right? Bank will claim from the government that 3% and they will charge you only 5% if the rate of interest of the EPC is 8%. Fine. The relaxation is not allowed for the transaction of sister or associate or group concerns. So replacement will not be possible when this type of transactions are involved, right? So monitoring of EPC will be done by the bank. Now the question is how to adjust EPC when exports do not materialize. That is a big question. So you had got one order, you had availed the EPC, but for any reason, you have not been able to ship the goods. What will happen to that EPC, which is outstanding, lying at the bank? So concessionary rate of interest will be charged up to 270 days. Most of the bank will charge you treasury bill plus some spread they will quote. Maybe they can spread could be 120 bips or 150 bips, depends on the bank's internal policy based on the treasury bill rate, and they will charge you. That will be much lower than the cash credit or OD facility, right? So this concessionary rate of interest will be charged up to 270 days. If shipment takes place after 270 days from the date of advance, means from the date you have availed the EPC, the advance will cease to qualify for concessional rate of interest ab initio, and interest rate applicable to domestic lending cash credit rate from the date of crystallization will be charged to you. So within the time you have not been able to ship, after the time you have been able to ship, then this will be applicable. But the question is, you have not been able to export at all for any situation, then what will happen to that export packing credit? So if exports do not materialize at all, banks should charge on the relative packing credit, domestic lending cash credit rate plus penal interest not exceeding 2% per annum from the date of advance. So since you have availed the concessional rate, but did not export at all, so there is a penalty. The charge for the entire advance would be domestic CC rate, cash credit rate, plus maybe as per bank's policy, spread would be there on that. Penal interest, maybe up to 2%, they can charge you from the date of advance till the time you liquidate that. Okay. So this is how adjustment of EPC will take place when there is no export at all. Now, a few more concepts we need to understand how you can liquidate EPC as an exporter. Once export is completed and bills are submitted, the pre-shipment liability should be converted to the post-shipment liability. It will be done by the bank. So when you will submit the export bill to the bank against the order, you have already availed the EPC. Now you have submitted the bill. What bank will do? They will purchase or discount that export bill. They will create post-shipment liability and they will knock off the pre-shipment EPC outstanding with that amount. Okay. So bank usually ensure to sanction pre-shipment and post-shipment both the facility to the exporter. So it is expected from the bank that when they sanction pre-shipment facility to the exporter, they will also sanction post-shipment facility. So in all cases where running account facility is permitted, bills pertaining to shipments have to be purchased, discount or negotiated as the case may be, right? So bank will also usually ensure that export credit available in respect of individual pre-shipment credit does not go beyond the period of sanction, which bank has assessed maybe 90 days, maybe 180 days. or as per RBI guidelines, whichever is earlier. And a bank will ensure calculation of drawing power. It should be determined on the basis of the aggregate value of firm order or LC lodged with the bank and outstanding or the advance value of the stock hypothecated to the bank, whichever is lower. So remember, EPC outstanding should be covered under this drawing power, which will be calculated by the bank. Okay. So usually there will be stock available when you avail, you take EPC facility. EPC facility you will take based on the confirm order or LC, but it need to be backed by the stock. Bank need to calculate drawing power. Within that drawing power only, bank will disburse the EPC facility to you based on the confirm order. Fine. Going forward, liquidation only. How you can liquidate EPC? Proceeds of export bill. So documents were sent on collection. Maybe payment has come, or maybe bank has already discounted. With that, EPC can be liquidated. Advance remittances. If you have received the advance remittances, from there also EPC can be liquidated. Proceeds of duty drawback, that can be used for liquidation of EPC. Out of EFC balance also can be used for this purpose. But please remember, EPC cannot be liquidated by debit to CC account. CC account usually will be used for the domestic working capital, right? So even if there is balance available in CC account, bank will not debit and liquidate the EPCM because EPC need to be liquidated through the export bill realization, inward remittances. Okay. Going forward, we need to understand post-shipment. So pre-shipment, we have availed. We have procured the goods, raw material. We have manufactured the goods. We have shipped the goods. Now we have got entire export bill. So maybe bill of lading is there, maybe commercial invoice and whatever things are there. I mean, as per sales contract, whatever you need to give it to the importer, all those bill you will submit to the bank. Okay. So once you do that, what bank will do, since bank have already sanctioned the pre-shipment, the bank has already also sanctioned the post-shipment. So they will simply purchase or discount that bill which you have submitted, and they will knock off the pre-shipment outstanding against that particular export order. So post-shipment credit is extended by the bank after the shipment of goods till the date of realization of export proceeds. There will be gap. Why gap? Because maybe you have already given 30 days credit to the importer. So you are not going to get the payment immediately. You have already extended credit period to the importer. So importer will effectively be making the payment after 30 days from the bill of lading. So your money is blocked. It is there in receivable forms. Okay, so bank fund that part also. So we call it post-shipment. Post-shipment credit is extended after the shipment of goods till the date of realization of exports proceeds, whatever it may be, 30 days, maybe 60 days also. So post-shipment you can avail in two forms, like we have discussed in pre-shipment, in rupees and dollar also. So post-shipment can be in the form of export bill purchase discounting negotiated under confirm order, and advance against bill which bank has sent on collection basis. There also you can avail the post-shipment credit against those export bills which have been sent on collection. Bank has not funded that. Bank has simply forwarded the export documents on collection basis. You want some funding against those, that is quite possible. If limit is there, bank can go ahead and give you the post-shipment advance against those bills which are sent on collection basis. Post-shipment can be availed in the form of advance against duty drawback receivables from government. So against this also, bank may disburse the post-shipment, and you can avail post-shipment credit against retention money deposit. So you have exported some machinery or project related things where retention money is outstanding with the importer, maybe 5%, 10% retention money is there. You can ask the bank to give post-shipment credit against that also. Fine. So you can avail post-shipment against exports on consignment basis also. So whatever you want to avail, we need to tell the banks upfront that this is how you are going to export, and you will be your export you will not be able to get the real export realization immediately. So you would require post-shipment credit from the bank. So you can tell the bank so that bank can assess this and they can factor in the proposal. They can give you the post-shipment credit against these, you can say, in these forms also, right? And obviously, if you have received the export LC, then maybe that LC says that you will get the payment after 90 days from the bill of lading date. You have submitted the documents to the bank. Bank may go ahead and do post-shipment credit against that also. Okay, bills negotiation under export LC. Going further, how you will liquidate the post-shipment credit. So you have submitted the bill. Now bill has been purchased by the bank. Outstanding is there. How that outstanding of that particular bill, export bill, will be liquidated by the bank. So liquidation of post-shipment credit has to be done from the proceeds of export bills received from abroad in respect of goods exported or services rendered. So let us take one example that initially you had received one export order for $10,000. You have approached banks for pre-shipment credit. Bank has given you EPC. That means EPC has been granted by the bank 90% of FEV value of 10,000. You have already got 9,000 equivalent rupees amount in EPC. Now you have manufactured the goods and you have shipped the goods. Now you have submitted the documents for $10,000 against that confirm order. What bank will do? Either bank will simply purchase it and knock off the EPC amount for $9,000 equivalent rupees amount, and rest you can use it, 10% you can use it. So this outstanding of 10,000 post-shipment bill outstanding need to be knocked off when actual payment will be received for that particular export bill. So foreign bill discounting can also be prepaid or repaid out of balance in EEFC account, exchange earners foreign currency account, or from proceeds of any unfinanced bill. So maybe you have already sent the document without asking for post-shipment finance. So maybe you have done 10 exports. Against 10 exports, only 5, against 5 bill only, you have availed foreign bill discounting. Post-shipment finance, you have availed only for 5 bills. Rest 5 bills is free. Those have not been financed by the bank. So if one bill where you had got the post-shipment finance is outstanding and you have got the payment from unfinanced bill, it can be knocked off. Okay. It can be knocked off by that particular bill which has not got finance. However, for that, since payment has not come for one particular bill, therefore, as an exporter, you are entitled to knock off that bill from the proceeds received from any unfinanced bill. But that export bill, which has not been realized, will be continued to be followed up for realization of export proceeds, right? So that obligation is there, though outstanding against that export bill will be knocked off by another export realized bill. Absolutely fine. Goods and services moving from DTA, domestic trade, domestic tariff area, to SEZ, special economic zone, are treated as deemed export and are eligible for export credit facility. So many of the time there will be confusion. What is DTA? To understand DTA, we need to understand what is SEZ. Okay. So SEZ is a geographical delineated duty-free enclave and shall be deemed to be a foreign territory for the purpose of trade operations and duties and tariffs. What about DTA? Domestic tariff area. DTA as defined in the SEZ Act means the whole of India, excluding that SEZ. So entire India territory, which does not fall in SEZ, you can say is DTA. Hence, all the territory outside the SEZ in India is the DTA, right? So goods from DTA to SEZ will be treated as deemed export and will be eligible for export credit finance. Okay. Now, whatever we will discuss further, that pre-shipment and post-shipment both can be availed in foreign currency. So RBI has credit in foreign currency scheme to avail pre-shipment in foreign currency and EBR. EBR means post-shipment finance in foreign currency, exports bill rediscounting. PCFC means pre-shipment in foreign currency. EBR means post-shipment in foreign currency. So both will be competitive than the rupees loan. If you avail EPC, that means you are availing in rupees. It will be charged more. If you avail PCFC, that means packing credit in foreign currency, maybe you will need to pay less amount than EPC. Like that, if you avail foreign bill discounting post-shipment in rupees, maybe you will need to give more charge. But if you avail post-shipment in foreign currency in the form of EBR, then maybe you can get good pricing from the bank due to foreign currency involved. So PCFC and EBR, pre-shipment and post-shipment in foreign currency, can be availed in majorly four currency: US dollar, GBP, Euro, and Yen. But we know that most of the transaction we do in US dollar only. Okay. So with this, let us understand PCFC, packing credit in foreign currency. So whatever we have discussed in pre-shipment, all those things will be there for PCFC. Only difference is now you are getting not in rupees, amount you are getting in foreign currency. For example, you have submitted $10,000 export order. Bank gives 90% of FOB value, means $9,000. So bank will give you dollar only. They will not convert in rupee and park in EPC. In case of PCFC, they will give you $9,000. They will open a fresh account in dollar and they will park $9,000. They will not convert that 9,000 in rupees like EPC account. So you can use this $9,000 maybe for import payment, right? Maybe you need to import raw material. So you can use that $9,000 for import payment. So there is no sale purchase of US dollar. So to that extent, cost will be reduced to you. Okay. Otherwise, what will happen that if you take it in rupees, then first from from rupees, you need to convert it to dollar to make the payment for import. Here you have got amount in foreign currency only, $9,000. You can use that. So pre-shipment credit in foreign currency, PCFC. Banks have been permitted to extend pre-shipment credit in foreign currency, PCFC, to exporter for domestic and imported inputs of exported goods at alternate reference rate based on currency, like SOFR for US dollar, SONIA for GBP, etc. So these rates will be applicable for your PCFC outstanding. Okay, not the typical treasury bill linked domestic lending rate would not be applicable here. So all exporters having firm export order or LC is eligible for PCFC, subject to satisfying other credit norms, and all norms remains the same. Like we have discussed in EPC, for PCFC, we need to fulfill those norms also. PCFC can be carved out of the EPC limit available to them, subject to the outstanding under both rupees pre-shipment EPC and PCFC, not exceeding the limit sanction. For example, you have been sanctioned 10 crore pre-shipment credit. Within that pre-shipment, it could be sanctioned that you can use both EPC as well as PCFC. So if you have outstanding of 6 crore in EPC in rupees, then 4 crore is available to be used for PCFC. Definitely put together, EPC and PCFC should not cross any time beyond the sanction limit of 10 crore. This is for example, right? There is no need for sanction of a separate sublimit of PCFC. So once you have got EPC limit sanction, bank definitely can give you packing credit in foreign currency also. The guidelines related to EPC also apply to PCFC. Same. Okay, whatever we need to comply in EPC need to be comply in case of PCFC also. Only difference, EPC we have taken in rupees, PCFC we have availed in foreign currency. Few more things we need to understand here, how to liquidate PCFC. Understand that outstanding is in dollar now. $9,000 is the outstanding amount. How to liquidate that? So PCFC should necessarily be liquidated out of the proceeds of the related export bill under export bill discounting scheme. So now you have availed $9,000, which is lying in your account, US dollar 9,000 in PCFC. You have already shipped the goods. You have submitted the documents to the bank for $10,000 because $10,000 was the export order. What bank will do? The bank will convert. Bank will purchase that $10,000 export bill. Bank will simply, you can say, give the post shipment for that. They will do that under EBR scheme. They will knock off the $9,000 and rest $1,000 will be available to you for use. That is possible. Okay. So the export bill tendered in respect of export orders against which PCFC has been availed cannot be sent on collection basis, as this is made mandatory by RBI. The bills are to be necessarily discounted under EBR. Please understand, this is important that you submit the bill against which you have already taken PCFC. Prior to that, export order was there. There you had already availed PCFC. Now you have submitted the export bill that need to be converted or discounted under EBR, so that PCFC outstanding of $9,000 can be knocked off. It will not be sent on collection basis. Advance remittance or separate inward remittance received in respect of orders against which PCFC have not been availed can be used to liquidate the PCFC. So here, against which PCFC has not been availed, not word has to be there, okay, can be used to liquidate the PCFC, right? So you have already sent documents, export documents, and now payment has been received. With that export realization, you can knock off the PCFC outstanding, which is there in foreign currency. PCFC availed against a particular contract can be liquidated with the proceeds of the bill relating to another contract for which no packing credit has been availed, or by an advance remittance in respect of export order for which no PCFC withdrawal has been granted. So basically, there is a flexibility. You have availed PCFC for one order. If you're not able to get the export realization for that particular order, maybe there is another order where you had shipped the goods, now payment has been received, you can knock off that. Another order PCFC can be knocked off by another order realization. That is possible. Proceeds of export bill sent on collection or otherwise against which no PCFC packing credit has been availed can also be applied to liquidate PCFC loan plus interest. So those flexibility is given now. So you can say that you have availed PCFC for one order. For any reason, there is a delay in getting the remittance against that order. Maybe another remittance has come that can be used for knocking off the previous PCFC. That is quite possible. Okay, when you use the running account basis. Fine. Then few more concepts we need to understand. Closure of PCFC due to cancellation of export order, right? Now you have availed $9,000. It is lying that debit outstanding is there, US dollar $9,000. But against which that PCFC was taken, that order has been cancelled. You will not be able to execute that order. So in case of cancellation of export order, PCFC may be closed by selling equivalent amount of foreign exchange principal plus interest at TT selling rate prevailing on the date of liquidation. In such cases, interest will be payable on the rupee equivalent of principal amount at the rate of 2% over the interest rate payable for cash credit account after adjustment of interest on PCFC already recovered. Okay, so now you cannot be charged international rate. Now you need to pay penalty also. You need to pay the CC rate, normal rate. Okay, so whatever you have already paid to the bank, that will be excluded, and rest amount now you need to pay because there is no order against which you had availed the PCFC. PCFC may be extended to such exporters subsequently only after ensuring that earlier cancellation of PCFC was due to genuine reasons and not for speculative purposes, right? So as an exporter, we need to convince the bank that it was a genuine reason that order was cancelled. And bank, if they are convinced, they can allow you to avail PCFC for another export order which you have received. That is possible. Okay. So now PCFC, then EBR. EBR means you are availing post-shipment financing foreign currency. Export bill rediscounting scheme, EBR. So all export bill, whether it is a demand, site bill or usance, maximum period of 180 days, including grace and transit period, can be discounted under EBR scheme of the bank. All exporters are eligible to cover their bills drawn under LC, maybe open bill or collection bill within the sanctioned post-shipment limit. Within that, if you give the documents to the bank, bank will be happy to do discounting under EBR scheme, and they will give you the amount in foreign currency. right? Foreign bill discounting, there they will convert the amount in rupees. Post shipment in rupees means they will discount $10,000 and they will convert that amount in rupees, and that will be going to liquidate the EPC. But in case of EBR, post shipment will be given in foreign currency only. So as an exporter, you can avail pre-shipment in foreign currency like PCFC, and you can discount export bill in foreign currency under EBR. So you have availed PCFC in US dollar, and you can avail post-shipment discounting under EBR in US dollar only. But you have the choice. You can avail pre-shipment in rupees, and you can avail post-shipment either in rupees, foreign bill discounting, or under EBR, discount of export bill in foreign currency. This option is available to you as an exporter, right? So these all were the basically you can say pre-shipment, post-shipment. Within pre-shipment, we have discussed EPC, then foreign, then PCFC, then post-shipment, it is foreign bill discounting is rupees and EBR in foreign currency, right? So few more things we need to understand related to that. Crystallization of PCFC or EBR. That means we are talking about the foreign currency transaction. On certain occasion, if customers who have availed PCFC are unable to submit relative export bill or bring any foreign currency from abroad for liquidation of the loan, then they have no other option but to buy foreign currency equivalent to PCFC loan already availed from the domestic market. We do not have any choice. $9,000 is outstanding, against which export is cancelled. So we have not exported. Then what to do with that $9,000? Then there is no choice but to buy foreign currency equivalent to, for example, $9,000 from the domestic market, right? Such transactions will be treated as PCFC crystallization. That is related to PCFC. What about EBR? So export bill under EBR, which are not realized within 30 days from due dates, shall be crystallized, and the same treatment we need to give. So bill have been submitted to the bank for $10,000. Bank has already discounted under EBR. Due date is, for example, it is a 30th November, but money does not realize within 30 days from the due date, 30th November. Then it need to be crystallized. That need to be crystallized means it need to be converted into rupees. Okay. So this was basically crystallization of PCFC and EBR, which have been availed in foreign currency. Now, few more concepts we need to understand how bank assess the export credit. What is the mechanism? So we have seen that it is a pre-shipment and post-shipment. There are two components, right? So pre-shipment to meet the need for manufacturing the goods for export, and post-shipment will be required when the goods are shipped, and advance need to be given to the exporter so that till the time payment is received, right, to meet that requirement. So accordingly, the assessment also includes these two aspects. So here we need to understand that PCFC may be carved out as a sublimit within the overall pre-shipment EPC facility. Fine. So this is one of the, you can say, diagram which will indicate both stages, pre-shipment as well as post-shipment finance. So working capital cycle has been shown here, cash to cash. So what will happen if you have got the cash? What will you do? You will procure the raw material. And raw material you need to hold. Maybe 30 days you need to hold, maybe 2 months you need to hold the raw material, and where money will be blocked. or maybe raw material has been converted into work in progress or stock in progress, and that time could be 15 days, 30 days also, many of the cases. Then this work in progress will become finished goods. And maybe finished goods also you need to hold for 15 days or 30 days. So money is involved. Okay. So once finished goods, you need to hold, and then shipment takes time, maybe 15 days, 30 days. So till the time shipment is done, whatever is the working capital requirement to meet that requirement when bank funds, that we call it pre-shipment credit. Once shipment is done, there is no stock now for that particular requirement. And what will happen that you would have given some credit to the importer, maybe 30 days, 60 days after the bill of lading, importer need to make the payment. Or maybe you have not given any credit to the importer. But when you submit the document to the bank, bank forwards the documents to the importer's bank, and the importer's bank need to approach the importer for making the payment. It may take time. To that extent, fund will be blocked. So at that time, bank helps you by way of post-shipment credit. So this is the way bank assess both the part, pre-shipment till the time shipment is done, whatever is needed by the exporter to fund that, pre-shipment is there. Once shipment is done, till the time fund has been received, money is blocked, their bank gives post-shipment credit, right? How do bank assess this? Okay, so it is very simple. For example, this is one of the example I have taken. So let us take one example that your estimated or projected export sale is 50 crore. So estimated profit is 10%. So you reduce from that. Now export sale after reducing profit is 45 crore. This is the annual sale, 12-month sale. So just find out per month sale will be what? So 45 divided by 12 will be 3.75 crore is the monthly export sale. So average raw material holding, how many days you need to keep the raw material? Maybe 2 months raw material you need to keep. What is the average processing period? Maybe 15 days it takes. So 2 months plus 15 days, 2.5 months. So average export sale multiplied by 2.5, you will get the total requirement of 9.38. Working capital you need. Now, bank may say that you need to bring your margin also for that working capital. Maybe bank can stipulate 15% will be your margin. So you have brought your margin, 15% of this 9.38 crore will be 1.41. So rest amount bank will fund as a pre-shipment limit, 9.97, maybe round off, you can take it, 7.90 crore in this example have been arrived for pre-shipment credit, where you can give the export order or maybe LC to the bank, and within this limit, bank will be disbursing EPC or PCFC. Now come to the second part, post-shipment. Total foreign bills to be purchased during entire year will be the entire amount of 50 crore. Okay, this is what we have estimated. So during the year, 50 crore will be the foreign bill to be purchased by the bank. Okay, so every month you can say, if you divide by 12, you will get the figure 4 crore, 17 lakh will be the average export receivables per month. For example, you have given 2 months time. Average export receivables period is basically 2 months time. Per month receivable is 4.17. So 2 months, you simply need to multiply 4.17 multiply by 2. You will get the figure 8.34 will be the post-shipment limit required. So round off 8.30. So in this example, whatever we have discussed, 7.90 is the pre-shipment limit and 8.30 is the post-shipment credit. And bank may give you total export finance 16.20 with this example. Please understand, if this 1 month is, this 2 month is only 1 month, then to that extent, your requirement will get reduced. Or maybe this export receivable time is not the 2 month, only 1 month, then also this requirement will go down, right? So depend on your working capital cycle. What is your inventory level you need to maintain in days or months? How much credit you give to the buyer, importer? That will depend on assessment of export credit by the bank. Okay, this is one of the simple example I have taken. Fine. Now the question is how to approach the bank for export finance. Whatever we have discussed, I can tell you the procedure remain the same for like you avail any cash credit facility, because bank in India will definitely give you EPC, PCFC, foreign bill discounting, but the assessment, they will require all the documents from the banks. Okay, so quickly, briefly, we can see here a profile of the company and its promoter. We need to submit to the bank. Past 3 years of audited balance sheet. If your company is existing one, you can submit those details to the bank. CMA. CMA is what? Last 2 years actual and current year estimates and next year projection we need to give to the bank. Based on that only, they will assess the, you can say, working capital requirement, export credit requirement, not based on the past, but based on the current and projection. They will assess collateral details. If anything is available, definitely we can give comfort to the bank, because bank definitely would like to explore the possibility of getting the collateral. Okay. So for any reason you have not been able to offer any collateral, maybe you can ask the bank to sanction the loan under CGTMSE scheme. But loan component would be less, but definitely to start with, you can do that. If you have availed any present working capital facility with any bank, you need to tell the bank. And whatever trade cycle we had discussed, whether you need to keep 1 month raw material or you need to give 30 days export, you can say credit to the importer, those things we need to tell to the bank. What is the trade cycle, working capital cycle of your business, need to tell the bank. Purchase order in hand, so that bank will have comfort that, okay, fine, these are the orders available with you. Current invoices from the suppliers or client may give you a lot of comfort to the bank that, okay, fine. Asset and liability statement of promoter, director, guarantor. Information on related group companies, suppliers, buyers, bank may require. So these are brief, you can say, details. Usually bank would require from any of the customer, whether you go for export credit or working capital normal for domestic sale purchase, right? So bank statement and GSTR 3B, if your company is basically GST compliant, then those things would be needed. Bank statement definitely would be asked by the bank these days. Last 2 year ITR, latest copy, partners, proprietors, so directors, etc. need to submit it, bank statement in PDF. Almost all the banks would ask this to check the conduct of the account. Entity proof of the company, maybe your company is limited company, private limited or limited, maybe ROC or memorandum, everything they will ask. Okay. KYC documents definitely would be asked on the individuals like promoters, partners, directors, etc., PAN, Aadhaar, etc. These all are basically KYC documents. Net sales figure for last 12 months. Usually balance sheet will give you the give the picture for the entire year. Okay, so many of the bank would ask you that, okay, give me the bifurcation of month-wise figure, sales figure, so that they will have a comfort that there is a spike or there is a trend, whether it is smooth or few of the months, lot of sales you do, or that pattern they want to check it. top five buyers and suppliers, name of the firm, contact details, etc. Bank may ask you. So if you submit, they can cross reference. Maybe they want to verify, then they can do so. Okay, copy of sanction letter. If you are already banking with any existing bank, you want to go for takeover, then that need to be provided. So these are basically very brief thing. Normally, all the loan proposal would carry this, but the similar type of requirement would be there from the bank side if you approach the bank for export finance also. When we say export finance, then uh, one more thing is there that there is RBI's gold card scheme for exporter. I'm not sure how many of you are aware about this scheme. So I thought that let me cover this. RBI gold card scheme is a scheme to incentivize exporter. The scheme envisages certain additional benefit based on the record of performance of the exporter. The gold card holder would enjoy simpler and more efficient credit delivery mechanism in recognition of its good track record, right? So I have given the circular number here, and gist I have given. I have not gone into deep, but few points I have mentioned which may be helpful for all of you. Okay, so this gold card scheme includes SMEs, you can say, and MSMEs, both sector. So gold card holder exporters are granted better terms of credit, including rate of interest, charges, fees, than those extended to others. Applications for credit will be processed at norms simpler and under a process faster than for other exporters. In principle, limit is sanctioned for a period of 3 years with automatic renewal provision. So in this gold card scheme, once it is sanctioned, it will remain valid for 3 years, obviously subject to certain terms and conditions. Automatic renewal will be there. Almost all the working capital sanction will have validity period of only 1 year. But in this case, in principle limit is sanctioned for 3 years with automatic renewal provision subject to certain condition, right? In this scheme, a standby limit of not less than 20% of the assessed limit is additionally available for urgent credit needs to execute sudden orders. So under this scheme, for example, you have availed 5 crore. 5 crore limit has been given to you. By default, you will be entitled 20% of 5 crore in case of emergency. By default, it will be inbuilt in that. Means 20% of 5 crore will be 1 crore ad hoc limit, you can say. 5 crore is definitely available to you, but 1 crore additional you can use for urgent credit need. Okay. This is inbuilt in this scheme. In case of unanticipated export orders, norms for inventory may be relaxed, taking into account the size and nature of the export order. Few more things are mentioned here. Upper cap for processing time by bank have been fixed at 25 days for fresh application, 15 days for renewal of limits, 7 days for ad hoc limits. This is the time frame given under this scheme. Bank has to take a call. If you apply, 25 days are given to them to sanction it. Renewal only 15 days. Ad hoc limit of 20 percent, only 7 days. Preference in granting packing credit in foreign currency out of available FC and RB funds. Value-added services like ATM, internet banking, international debit credit cards, foreign currency credit card will be given to you. Waiver of collaterals and exemptions from ICICI guarantee schemes may be considered based on credit worthiness and track record. So if your track record is good, then definitely under this scheme, bank may waive the collateral. Okay. Or bank, usually nationalized bank would require the ICICI policy to be taken. Maybe in this case, they can waive that also. But remember that exporters blacklisted by ICICI or with overdue export bills more than 10% of previous year's turnover are not eligible to avail gold card scheme from the bank. Okay. So this is how bank basically you can avail facility, export credit facility from the bank. Okay. Now, few more thing I wanted to discuss here, bill discounting under LC. So this is available to exporter, whoever has been able to get LC, means export LC. So remember, whatever we are going to discuss here, for that, there is no requirement for bank to sanction a separate, working capital limit. Okay. So seller, beneficiary of the export LC, can get the funds from the negotiating bank by way of negotiation of bills under export LC, wherein documents submitted by exporter comply fully with the LC terms. So you have received the LC, you have shipped the goods, you have presented the document as per LC terms and condition. You may get payment from the nominated bank. Okay. So for bill discounting under export LC, there is no need for any working capital limit, as bill discounting under LC will be treated outside the purview of SS Bank Finance. Whatever we had discussed, how bank does assessment will not be applicable for bill discounting under LC. Bank will take a call on the issuing bank's creditworthiness. Under LC, they will take a call. Okay. So whatever amount you will get here when you go to the bank for negotiation of documents under LC, limit will not be blocked. Your working capital limit, sanction limit, pre-shipment, post-shipment limit will not be blocked when it is backed by LC transaction. And the operation under LCs are governed by UCP 600 ICC publication. Post-shipment finance can be extended up to 100% of the invoice value of the goods, means entire. So $10,000 is the LC amount. You have presented documents for $10,000. Entire amount can be given to you. Obviously, if usance period is there, for example, LC says 90 days from the bill of lading date, then bank simply will discount, give the entire amount, and they will take the discount charges for that 90 days. In case you get confirmed LC, so in that case, confirming bank must purchase, discount, negotiate bills under LC without recourse to the beneficiary when complying presentation has been made. Without recourse means what? If confirmation has been aided by local bank in India. So you have received one LC from Bangladesh. But challenge is that you are not comfortable. What is the country specific position is there? Though you have received the LC, you may like to have that LC to be confirmed by local Indian bank. Maybe bank A has confirmed, which is based in India. So now documents have been presented to bank A. Bank A must discount or negotiate if documents are complying. And when bank A, who is the confirming bank, give you the money, they give it to you without recourse. What does it mean? Tomorrow, if that bank A is not able to get the payment from the issuing bank based in Bangladesh, then they are not going to tell you that return back the amount. No, they will not ask you. It is without recourse. Once money has been given to the exporter, that is final. It cannot be called back. But if it is case of non-confirmed LC, means no confirmation has been aided by any bank, in that case, bank usually will negotiate the bills under export LC when issuing bank has given acceptance advice to the negotiating bank. So if it is case of unconfirmed LC, what you do, you present the documents to your bank will forward it to the issuing bank. So issuing bank, once they give acceptance message, then only usually bank in India will discount and give the money to you. Okay. Otherwise, upfront, they will not like to give you the money. In case of site LC, straightforward, issuing bank will remit the fund and you will get it. But in case of usance LC, unconfirmed, like 90 days from bill of lading, maybe due date is 31st December. Now acceptance message has been received by your bank. Your bank may discount based on that acceptance message received from the issuing bank. Okay. So this is simple bills under LC. Okay. Now, apart from bank, you may get funding from factoring companies also as an exporter. Okay, so this is basically post-shipment finance. Okay, so quickly we will understand what is factoring. So factoring reduces the impact of outstanding receivables on exporters' cash flow by selling export invoice at a discounted rate to a factoring company. So it is possible that you have given 30 days, 60 days credit period to the importer. So your money is blocked. You have availed pre-shipment, post-shipment facility with the bank, and entire limit has been used fully. Then what to do? You can go for factoring facility. But remember, if you have already availed any export finance against that export order, you will not be entitled to do so. But for example, more orders are there, but limit is full with the bank. Working capital limit, either pre-shipment or post-shipment, all are blocked full. And you have got additional order and you have executed the order. Now you have got the bill. What to do? Bank will not discount because limit is full. Then you need to wait for payment, 30 days, 90 days, whatever terms is there from the importer. There comes the role of factoring companies. They may simply purchase those invoice, which is payable after 30 days or 60 days or 90 days, right? So exporter may get up to 80% of export invoice value on the day of shipment rather than waiting for the complete payment from the buyer at the end of the credit period. So you have given 30 days credit to the importer. What you do? Today you have shipped the goods, you have collected the documents, and you can approach factoring company. So based on the already given sanction letter, factoring company can give you 80% of the export value. For example, you have today shipped the goods for $10,000. Now $10,000 is your outstanding. You are supposed to get payment after 30 days from the importer. You want to avail finance against that $10,000 export bill. If you go to the bank, maybe there is no availability of the limit. Limit has been full. So bank will not be able to discount that and give you the money. But you can approach the factoring company who will be willing to fund up to 80% of that export value. Means $10,000 is the amount of the export value. You will get $8,000 upfront by the factoring companies. So factor takes over the responsibility of collecting payment from the buyers so that exporter can focus on their business. On due date, buyer pays the full amount to the factoring company and exporters gets remaining 20% minus the factoring fees. This is called export invoice factoring, sometimes also referred to as invoice discounting. It is a collateral-free finance. You do not have to offer any collateral security to the factor. Simply, you need to tell who is the importer and where is the importer is located. They will do the due diligence. If they are comfortable, they will give you okay that you can go ahead. We will be willing to do the factoring for that particular importer and country. And you do the shipment. You submit only copy of bill of lading invoice to the factoring companies. Depend on the terms and condition what they want. They want the original to be sent to them or only copy will work. and accordingly, they will disburse 80% of that export order in your account. Okay. So factoring provides export finance without any collateral, security, or business financial, because they will take a call on the importer. Fine. So factoring can do quick processing of the proposal and transaction. It is possible to get factoring facility on order-to-order basis. So order-based funding is possible. Exporters get immediately release of their working capital from foreign trade transactions and can utilize the funds for inventory, raw material, employees, and other working capital requirement. This is a non-recourse basis transactions, which means that if buyer defaults on making the payment to the factor, the obligation to pay back the amount does not fall on the exporter, as all the finance invoices are insured. So you had shipped goods worth $10,000. You have already got $8,000, 80% of that from factoring companies. Tomorrow, what if buyer does not pay? For any reason, buyer does not pay. In that case, since it will be non-recourse basis transaction, factoring team will not ask you to return $8,000 to them. So to that extent, your risk is mitigated when you go for factoring of your export receivables, right? There is no need for export LC for doing the factoring. So without LC, these all export bills can be factored. You can get 80% of the amount upfront, and 20% when buyer makes the payment to the factoring companies will recover their charges, and rest amount will be paid to you. Okay. It is a post-shipment finance available to the exporter beyond bank's working capital. Okay. So additional funding you will be getting from factoring companies. So if you have not explored, you can explore this facility. If you are your customer, you give the importers some credit, then it will be very useful, right? 30 days, 60 days, maybe up to 90 days, they'll be happy to do factoring for those invoices, export invoices. Fine. So one more concept I wanted to touch upon, that is ITFS. Okay. International Trade Finance Services. Okay. So let us understand this ITFS. What is that? So ITFS, International Trade Finance Services Platform, is an electronic marketplace for facilitating the trade finance requirement of exporters, exporter and importer both. But we are focusing right now on exporter, right? What is this? The objective of the ITFS is to facilitate various types of trade finance requirements. ITFS platform brings global liquidity to SMEs, MSMEs, and benefit the ecosystem. Supply chain underperform because affordable and timely financing is often unavailable to SMEs. This is because traditional bankers like banks find it expensive to fund SMEs, thus making low-cost financing difficult. That is the challenge we all face. When we approach the banks, they will have a lot of requirement and very difficult to fulfill their requirement. Maybe we will not be able to convince them, satisfy them. Maybe we will not be able to avail credit facility, export credit facility. Okay, we are the exporter, but despite that, maybe due to the banking internal own guidelines, somehow we are not able to avail those export finance from banks, traditional, because they believe in traditional banking, right? So MSMEs do not have access to global banks or international factoring service providers to obtain financing or factoring. Financiers like Indian or foreign banks, factoring companies, insurers, etc., registered under ITFS can seamlessly provide trade financing facilities to Indian MSMEs, and that too at a comparatively lower cost. So this is basically, you can say it is a marketplace, online marketplace, okay, where all the parties will be available. Financier would be there, banks would be there, insurer will be there, exporter will be there, importer will be there, and they do this online, you can say, receivables financing, okay. So when exporting goods to buyer overseas, suppliers typically wait 30 to 120 days for payment. Such deferred payment is normal in international trade, but it ties up capital and can have a crippling effect on cash flow and business growth. ITFS helps exporter to bridge out this gap by providing low-cost
Ma'am, can you
financing
tell me your name?
in a very secured network through its digital enabled platform. So it is totally digitalized platform marketplace. So ITFS framework provides an opportunity to the participant to avail trade finance facilities for trade transactions such as export, invoice trade financing, reverse trade financing, bill discounting under LC, supply chain finance for exporters, packing credit, export credit, insurance credit, guarantee, factoring, and any other eligible products on the ITFS platform. So basically, you can say these platforms can be used to ease the post-shipment requirement. Okay, so Government of India has established IFSCA, International Financial Services Centers Authority, in April 2020, which is located at Gift City, Gandhinagar in Gujarat. And IFSCA is the has got the regulatory powers of 4 financial services regulators in India: RBI, SEBI, IRDAI, and PFRDAI have been vested in IFSCA, making it a unified regulator for the IFSC. So a few of the ITFS platform which are active, you can say, like Raxil Global IFSC Limited, Vayana Trade Exchange, Mind IFSC, etc. are in operation. So if you want to go for invoice discounting, you can register with these platforms. They will do the KYC and whatever formality you need to comply. And once you completed the entire requirement of that platform, maybe you have shipped the goods, you can upload the invoice online. And once invoice is basically approved by the importer, then one financer may bid, and financer may give you the money upfront, and they will be able to collect the payment on due date from the importer. So this mechanism is available to all the exporter. Online it is available. Okay, so with this, this is the last slide. If any queries there, you can feel free, you can ask.